Good afternoon, everybody, and welcome to another webinar from Mariner Wealth Advisors. My name is Jude Grimaldi. I'm one of the members of our practice management team here at Mariner, and I will be your host this afternoon. So today I'm joined by a very special guest, Jodi Robinson. Jodi is one of our managing directors on our tax team, and she is a resident expert here on our topic, 5 things to consider before the end of 2022. So before we jump into anything, I just wanted to go over a couple housekeeping items. So we want to make sure that this session is as engaging as possible. So if you do have any questions, you can submit them in the Q&A feature that's at the bottom of your screen. And if you do have any comments, you can always feel free to submit them inside of the chat. Now, all of our webinars, all of our monthly webinars are recorded, so you can find them all on the Mariner website. So you can just go to marinerwealthadvisors.com, or you can Google Mariner Wealth Advisors webinars, and then that should bring you directly to the webinars link there. And you can find all of our previously recorded webinars. So today, our session is all about tax planning. And why is tax planning important? Well, when you're anticipating the taxes, when you are creating your financial plan, you're going to be able to significantly increase how much wealth you're going to have in the future. And tax planning is so incredibly important because it's one of those pieces of the financial plan that are going to fit no matter where you are in that life cycle or in that financial planning journey. So whether you're, doing cash flow planning, doing retirement planning, doing estate planning, tax planning overlays every single one of those. And there's a lot of different strategies that are going to be timely. And so that brings us directly into our topic today. So what are 5 things that we should be considering thinking about tax planning before the end of 2022? So although it might seem a little bit early to start thinking about your tax filing, doing now, you're going to be able to optimize deductions, develop strategies to help minimize that tax burden. So as I mentioned, even though we are a little bit early, the timing is going to be incredibly important. And so it's never really a bad time to think about tax planning. So some of the topics that we're going to talk about today. So first we have charitable giving. We're going to go into a little bit about Roth IRA conversions, some different strategies and opportunities in a difficult market, as we are all familiar with as what we are in now. Some tax loss harvesting, and then for business owners specifically, thinking about starting a retirement plan. So let's just jump into our first topic. Let's talk a little bit more about charitable planning. So Jodi, I'll ask you, what things should our listeners be thinking about from a timing perspective?
So, one of the things that we talk about is not waiting until the very last day of the year to do this. So now is a great time to start thinking about these things, and specifically charitable giving. And one of the things that we encourage is taking advantage of donor advised funds. A lot of people think that in order to make a charitable contribution, they need to know specifically the charity they want to make that donation to, that it needs to be cash, they need to write a check, but you do have options. One of the things with donor advised funds is that you can actually take a deduction now without having to identify who the recipients are going to be. So instead of making, your annual $5,000 gift to the church, in order to maximize a deduction in a specific year, accelerate those deductions into the current year, we would recommend that you make a $20,000 donation into a donor advised fund, and then you can continue to make those contributions to the charity over a period of years. So it gives you options, and you might, change your mind as to who you want the charitable recipient to be for a particular reason. So, the great thing about the advised funds is you can bunch your deductions to accelerate the deduction, and then you have the flexibility of who you actually give those funds to over a period of time. Right. And then other than cash, we also encourage gifting appreciated securities. So instead of a lot of people, when you want to give a cash donation, you've got to complete a sale with a stock or in your advisor fund. Instead of doing that, just gift the actual stock to the charity so that you reap the double benefit of that.
That's
yeah,
good.
and so this slide gives a good example of that.
Awesome.
So just to kind of high level walk through what that would look like. If you own a stock, the example we used here was if you owned a stock worth $50,000, which you had originally purchased for $20,000, you're sitting on $30,000 of appreciation in that stock. If you chose to make a cash donation, you would have to sell that stock, pay the tax on that $30,000 of appreciation that you have, and then give the charity likely the net proceeds of that, the after-tax proceeds of that. So if you instead would flip that and donate the stock to the charity is getting more. In theory, they're getting a $50,000 stock, and you're also able to not pay tax on those gains because you're pushing the gains outside of your personal tax situation. So you're saving, tax dollars, valuable tax dollars, by choosing to donate an appreciated security instead of writing a check for cash. More bang for your buck, so to speak.
Definitely, that's great. And with that, that gift being available to be claimed as a deduction, getting that increased contribution, that's huge.
Absolutely. Absolutely. I mean, and you can easily work with, your advisors to help make that transaction happen between, your assets and the charity.
Right. That's actually a great thing that I'll comment on. If you don't have an advisor, or you are curious about what options are going to be best for you, what assets are going to be best for you to be considering about charitable planning, make sure you're having that conversation with your advisor, at any point in time. It doesn't just have to be towards the end of the year. This is going to be relevant at all times of the year. So just make sure that you are having that open dialogue. All right. So year end is a really good time to think about whether Roth IRA conversions are going to make sense. Can you talk a little bit on, some suggestions on whether to know if this is going to be a good idea or not?
Yeah. So, I mean, one of the things that, we want to do is try and get as much of your portfolio moved over to tax-free money in your retirement years. And the sooner that we can do that, the better. And specifically, timing it either to a year where you're going to have lower income, and you can in theory afford to layer on more income onto your tax return for a Roth conversion, or now in a down market. There are some upsides in tax planning in a down market. Roth conversions is one of those. So in theory, if you have $100,000, if you had an IRA that had $100,000 value in it at the beginning of the year, as this example shows, now when the market may have dipped, perhaps the value of that IRA has dropped down to $75,000. This could be a great opportunity for you, depending upon your own personal tax situation, to evaluate converting to a Roth now that the value of that IRA is decreased. Because then when the market does come back up, you can see that the last bar on the graph, you have then avoided taxation on that growth in the Roth that's now sitting in the Roth IRA once it's been converted. So, one of the things that we're recommending is that our clients and advisors, look at the opportunities that you may have to start converting portions of or all of IRA balances over to Roths during this down market. It may not work for everyone, but it's certainly a great opportunity to start exploring now. One of the things that you need to keep in mind is that in order to really make this work, you need to, if you're going to convert $75,000 of an IRA, you need to have outside funds outside that IRA where you can pay the tax dollars once you do that conversion, because you don't want to take tax dollars out of the IRA to pay those pay those taxes.
Yeah, I think you made a good point. I work with a lot of advisors every day. I work with all of our advisors nationally, and Roth conversions are one of the biggest things that I am seeing across the board for financial plans. But they are not going to work for everybody. But for the ones that they do work for, they're going to work really well. So, as Jodi mentioned, this is a really good opportunity to open up that dialogue and see what your options are for this, because they can be extremely beneficial from a tax savings standpoint, and then even just from overall retirement planning.
Yeah, absolutely. I mean, as I said, we want to try and get as much of your money into that tax-free category as we possibly can.
All right, exactly. All right. So are there any other silver linings or unique planning opportunities in the midst of this difficult environment? While we're talking about this difficult environment and rising inflation, high interest rates, do you think that there are any other opportunities or anything else to think about?
Yeah, so not all of the things that we're going to talk about here are necessarily income tax related strategies. This particular opportunity that we'll highlight is actually an estate planning opportunity. And it's not one that's widely used, and it may not, it's not for your everyday homeowner, but for particular clients and their particular situation, this may be a good way to transfer a valuable, highly appreciated asset, in this case, which is a personal residence or a vacation home, out of your estate, so that it is not all subject to estate tax when you pass on. So particularly dealing with what we call a qualified personal residence trust, what you will, in the accounting and tax world, we call it a QPERT. It offers a way for you to pass down either your primary residence or maybe a vacation home that you've had in your family for a long time, and you want to make sure that that stays in the family, but you'd like to avoid estate tax on it. You can use a QPERT to actually pass that out of your estate and on to the next generation. So QPERT gets complex very, very quickly, this transaction. So I'll stick to the high level. Really just wanted to get this nugget out there for those who may think that would be a benefit to them to use it. In a high rate environment is when this estate planning tool is more valuable. So when you are gifting complex assets for estate planning, a lot of those calculations are tied to an interest rate. So as Fed interest rates are rising, this strategy becomes more valuable because part of the complex calculation uses one of the Fed interest rates to actually calculate the value of the gift. So to kind of try and illustrate this high level, if you have a home that's worth $1 million and we think it's going to continue to appreciate in value, you use this Fed interest rate to determine how much the value is that I'm going to keep and how much the value is that I'm going to give away. So down at the bottom, the taxable value of the gift. In a high rate environment, we have a 3.6 rate here for illustration. The value of your gift that would get reported on a gift tax return is $363,000. In a low rate environment, which is the example below that, the value of your gift is about $500,000. So there's the strategy in a high rate environment. But to back up a step to just explain what a QPERT is, a QPERT, you would move your personal residence into this QPERT trust. It's a grantor trust, so it doesn't really exist as a separate living entity. But the strategy is that you continue to live in the primary residence, even though it's held in a QPERT. And then at the end of the QPERT term, that asset would pass to the children or the grandchildren. You could still live in it, but there would be some kind of likely rental arrangement after that that would allow you to live in it. So again, this gets very complex very quickly. I mean, as you can see, even to try and explain some of the logistics of it, it gets very complex and not something that you want to just run out and do. You want to make sure that this is a situation that's going to work for you, and that it makes the most sense for you and your beneficiaries ultimately. But it is a strategy to be able to pass along a high value asset for a lower value gift, thus using less of your estate exemption ultimately.
Right. See, as everybody can see, this definitely can get complex. Along with everything with estate planning goes, estate planning has so many different factors, and there's so many ins and outs of all the different trust strategies and so many different things that you can do. But here at Varner, we have all of the resources, not only for you, but for your advisors as well. So that's just I'll do a shameless plug here, but we do have a ton of different resources. I've worked with a lot of different firms over the years, and the resources that Mariner has are definitely different. They're more unique, and we have more than what I've seen across the board. And estate planning is no different. We have so many resources and so much available for you. So if you are, same thing with the Roth conversions, if you think that this might be something that you want to think about, then have that conversation with your advisor, just for estate planning as a whole, because that's going to be important. Even earlier on in that financial planning journey, you still want to think about the estate plan, because you can potentially set assets up earlier on to then give you more benefit down the line, whether it's saving on estate tax or, whatever that may be.
I think there's value in just initiating the conversation about, hey, is this a good strategy for me? Because having this conversation may determine ultimately that maybe this isn't particularly a good strategy for you, but let's continue to uncover some of the things that what are your goals? Do you want to leave money to charity? Do you want to leave money to your kids? So I think just initiating that conversation and starting to figure out, based on today's environment and my particular situation, what's going to be the best. I think having those conversations is a pretty big step in accomplishing your long-term goals. Definitely. And I know a lot of people don't kind of avoid that conversation, but now is the time to do it. Yeah. Don't wait.
Yeah, exactly. So far we've talked about charitable planning, talked about retirement planning, estate planning. What about on, the investment side? Because when I think about financial planning as a whole, those are really the three out of the four that I would say are the cores. So thinking about investments, what should we be thinking about?
Yeah. So, with the market down, you can, you may not have a lot of gains within your portfolio, depending upon, where your portfolio sits from an appreciation perspective. A lot of people still have other capital gain transactions going on outside of their portfolio, whether they might be engaging in some real estate transactions. Perhaps they've sold, some private stock that they owned, or a business that they've owned. Even in a down market, there are still people with outside transactions happening that are generating gains for them. So one of the things that you can do within your portfolio is look at tax loss harvesting. We typically talk about doing this, in an up market, but this is also an opportunity, certainly in a down market, to help figure out ways to offset other outside gains that you might have in your portfolio. So with tax loss harvesting, you are proactively seeking out investments when they're down that you can sell and realize that loss to help offset. Now, one of the things that you probably want to do is, once you sell for a loss, is get right back into the market, maybe in a similar industry, But one of the things that you can't do, and I think our next slide actually references that, is buy back the same stock within a 30-day time frame. So if I'm selling Apple stock for a loss, I have to wait the specified period of time before I can buy that back. Otherwise, the IRS has wash sale rules that will say, because you basically sold it to take advantage of the losses, you have to wait before you can get back into that specific stock. Now, that doesn't mean that you can't get back into, another tech industry stock, but you can't buy back the Apple stock and still be able to recognize that loss. So just a little note of warning there. Even though you can use it as a strategy, you have to be cognizant of some of the IRS rules in place that will technically disallow the loss that you just tried to create.
Right. Makes sense. So what about for business owners? Do you think is there anything that we should be considering if you're, setting up a qualified retirement plan for your company, whatever it might be?
Yeah, I mean, I think one of the things that as tax and wealth advisors, we always encourage our clients to do is set up some kind of retirement plan, whether or contribute to a retirement plan where you can, take advantage of a tax deduction and also pay yourself before you pay Uncle Sam. So take the cash that you have and invest it in yourself instead of paying taxes on it. So one of the things that small business owners should be thinking about is setting up and funding a retirement plan, particularly if it is a business owner with excess cash and you want to do something with that cash to put it to work for you. So instead of setting up just a traditional 401k plan, individual 401k plan. So we have a lot of clients, who as corp owners or sole proprietors, they have, they're the only employee in the company, which is typically what you want to be to do this add-on plan. Because if you set up this retirement plan, you would have to do it for all of your employees and not just for you. So it's really a targeted situation where it's really the owner is the sole employee of the company. So instead of doing just a traditional 401k or a profit sharing plan, you can actually establish a cash balance plan, which will pump a large dollar amount into your retirement plan, get you an additional tax deduction, not to mention the benefit of having, all of these additional dollars into a retirement plan that you can tap in the future for your retirement. So I think the next slide does a good illustration of the example of the dollars that you can put in. So in a traditional, if you had a 401k plan only, you're capped out at like a $27,000 contribution a year. If you take that 401k and you add on a profit sharing, you can get your deduction up to a $67,500 contribution, which is great. But if you turn that into a cash balance plan or a 401k with a cash balance plan feature, you can see in that cash balance column, you can, based upon the age of the participant, I mean, it's a calculation that's done based upon the age of the participant, their level of income, and the plan design. But you can typically add an additional 6 figures in a single year retirement contribution to one of these plans. So you can see it pretty quickly. If you had the cash to fund this every year for 10 years, you're putting $300,000 to $400,000 into this plan on an annual basis. This accumulates pretty quickly much faster than a $27,000 401k plan only. So the cash balance plan is definitely something worth considering. Again, if you have a small business that has excess cash or is cash flow heavy on an annual basis, and you're the sole owner, sole employee of the business.
Definitely.
And coincidentally, we do have a team of people within Mariner under our advisor solutions team that can actually assist with setting up one of these and helping you determine how much can be funded within that plan as well.
That goes right back to my resources. We have it done.
Absolutely.
So we've hit on the 5 things to consider before 2022, and I'll just go back to my earlier side. Does anybody have any questions about anything? Anything that we went over, and I'll pull this slide up so you can take a second look at that. We talked about charitable giving, Roth conversions, tax loss harvesting, different strategies in a difficult market. But I'm going to open up the floor right now to any questions that anybody may have.
I'll just jump in here as people are thinking of questions and just reiterate that, certainly we encourage people to do tax planning year round, but definitely as we're going into the last quarter of the year, it is so important to start thinking about what you can do to impact your 2022 tax filing. Certainly, once the end of the year closes, your options become limited as to what you can do. I think there may be a little more flexibility with retirement plans and things like that, but every time a tax year closes, that window of opportunity is gone as well. So instead of waiting until December to start thinking about these things, now is the time to start having those conversations and putting some of those plans into place. Because not all of these are as simple as pushing a button. Some thought goes into a lot of these different strategies. So the sooner that you can act on these, the better.
Yeah, that's a really great point. We did have a couple questions that came in regards to a cash balance plan. So can a cash balance plan go unfunded?
Yes, you do not have to fund it every year.
And so can a business owner do a cash balance plan even if they have, let's say, a W-2 job that they're maximizing their 401k contributions?
I think there's going to be some limitations there on how that gets set up. I would certainly defer that you reach out to someone within our retirement plan group to kind of talk about how that works. But I think if you're already part of another plan, there could be some restrictions on the specifics of what you can do setting up another plan.
Right. So is the cash balance plan, staying on the same subject, is that only for business owners or are the funds for all employees as well?
If you have other employees, in order to, there are some within retirement plans, there are like non-discrimination rules, which would mean that whatever you set up within a retirement plan typically has to be open and available to other employees as well, which makes you want to make sure that you're considering that when you're actually setting up the plan. Because if you're going to do a 6-figure contribution for you, you're probably going to need to have a lot of cash to do contributions for employees as well.
Right, definitely. So one question did come in on what Mariner's view on the future of the market is, and I will just defer back to our Crystal Ball Outlook webinar that we did in July with Jeff Crumpman and Katrina Radenberg. So definitely check out that recording. They talked all about the current market, future of the market, and Mariner's stance on that. So so jump into our website and just go to the webinars page, and you'll find the July crystal ball outlook. All right, so I'll go into one more question here. If somebody were to sell a rental house, can they defer capital gains of the sale by putting the gain in a retirement plan?
No, you can't. You can't do it quite that slick. You can't defer a gain into a retirement plan. You could. There are other vehicles in which you can defer gains. If you have a rental house that you want to sell, you can do 1031 exchanges, which would allow you to roll it into another like property. There are qualified opportunity zone funds that you could invest in. So really the only way to defer gains like that are to take those proceeds and roll them into another investment property, not into a retirement fund.
Right, that makes sense.
But there are opportunities worth exploring, worth
Yeah.
determining whether it's something that works for you.
Yeah, definitely. So this one's on Roth conversions. So the individual in question did a Roth conversion a few years ago. They're curious if they can do multiple Roth conversions. Are there any limitations to how many Roth conversions they can do?
No limitations. So, I mean, that's one of the nice things. If you had $500,000 in an IRA, you don't have to convert it all at once. If you wanted to time that out over, have it create a plan to do that over 5 years or whatever you wanted that to look like, you have the discretion to figure out the timing of that and how many times you would do it. If you wanted to do $10,000 of it, you could do that. No limitation.
Awesome, thanks, Jodi.
Mm-hmm.
We did have one more question that came in, and I'm going to defer this question as well. So they're asking a little bit more about their specific situation and whether or not a Cupid would make sense. This is a great opportunity to have that conversation with your advisor, to really analyze the full financial plan, analyze the full estate plan, and then figure out, based off of your assets, whether or not a Cupid would make sense.
Yeah.
All right, here is another on Roth conversion. So if you move to a Roth over 5 years, when do you pay the tax on it?
If you're doing it, as I had explained in the example, like $100,000 each year for 5 years, you're paying it every year that you actually make the conversion. So you would be paying tax on the $100,000 every year. So that's why you want to analyze, the timing of it, because you would really want to look 5 years out at what you're estimating, like what income tax bracket are you going to be in each one of those 5 years? Do you think one of those years you're going to have a peak in your income? Maybe that's not a year to do it because you're going to pay tax on the Roth conversion at a much higher tax rate. So you really want to have that part of a total financial and tax plan. Is get a vision for what does the horizon look like for me, and then how do I time the Roth conversion so that I'm hopefully not paying it at 39% or 37%, and paying it maybe in some years where my income might be lower and I can take advantage of that.
Right. Can you take losses if you have losses when you convert to Roth?
No. I mean, they used to have that. I think there used to be part of 2% itemized deductions potentially several years ago. But no, you can't deduct your losses on Roth conversions or in any of your IRAs.
All right. So thinking about Roth conversions and the timing, thinking about them in a market like today, are they typically more attractive in a lower market?
Absolutely. I mean, that kind of goes back to the slide that you actually have up there right now. If the value of your IRA was $100,000 at the beginning of the year and it's decreased since then, I would put some serious thought to whether you want to convert some of that now. The value of it is lower, and hopefully you're paying tax on the lower value. And then next year when the market is rebounding, the value of that goes up and you've already paid tax on the lower value of it. So yeah, absolutely. If you've got IRAs right now, I would be having the conversation and doing some analysis about whether Roth conversion is right for you or not.
When you're converting, if you have an account and you're converting a lot of stocks to Roth, are the losses subtracted for profit?
I'm not sure I understand the question.
So I'll defer this one as well. I'll hold off on this. And
So
then,
in converting stocks to Roth.
So I guess when they're converting the existing retirement plan has a ton of stocks into it.
Yeah, I mean, that kind of goes back to that other question about deducting losses. Yeah, if you've got losses within your IRA, you're not necessarily selling anything within the IRA to convert it to an IRA. So you're not having to realize any gains or losses within your IRA to convert it. It is just merely a rollover to a different type of account.
Right. And then when we're thinking about the tax brackets, as you mentioned before, is the tax rate on the Roth conversion always going to be on what your current tax bracket is that year? Or is it, a special rate that's lower than the current tax rate? Or...
Yeah, it's IRA conversions, IRA withdrawals, retirement distributions, all of those are taxed at your ordinary income tax rate for the year. So unlike, stock gains that get a preferential tax rate at 15 or 20%, a Roth conversion is always going to be taxed at your ordinary tax rate.
This is an interesting question that came in, and I personally never heard it. Can you undo a Roth conversion?
They've put some limitations on some of those. So I think once you decide you're going to do a Roth conversion, I think you want to put some serious thought into it, because I don't think you have the flexibility to play around with a lot of those things anymore. There used to be a lot of options to make a contribution and undo a contribution and do a conversion and undo a conversion. A lot of those the IRS has stripped away. So I think you would want to talk directly to your financial advisor about if you've already done something and you're thinking about whether it was appropriate or not. I would talk to your advisor and figure out what your specific options are. Yeah,
that's a really great point. There's a lot of different laws and rules that are ever changing. They change almost on an annual basis, especially in years where there's elections, whether it's, primary elections or whatever it might be. There is always this pending sense of what is actually going to change. So, the advisors that you have should be up to speed on them, or if they're not, they should have the resources that are up to speed on that, and they should be able to help you out, navigate whatever the situation may be.
Yeah, absolutely. And speaking specifically here to Mariner, our Mariner advisors are all, very tax savvy. In the event that they have a situation where they need help, they always have the Mariner tax resources to reach out to them, to help consult and advise with the client as well.
Perfect. Are there any other questions that anybody has here? Doesn't look like many are coming in, but Jodi, thank you so much for the time today. We really appreciate it. I've definitely even learned a lot personally. If anybody does have any questions in the future, you can always feel free to reach out to any of us here at Mariner. Make sure you're having these conversations with your advisor. And for those who have asked about the slide deck, we will send a copy of that out to everybody that has asked. And so I hope everybody has a great rest of your week and a great rest of your day. And as I mentioned, if you need anything, you can always feel free to let us know.
Thanks, Jude.
Thanks, Jodi.